To kick off the session, I'd like to introduce our first speaker, Mark Zepner, Managing Director of Ramelius Resources. Mark's a mining engineer and has over 30 years of experience in senior operational and management roles with WMC and Goldfields at gold and nickel assets in Australia and offshore. He joined Ramelius as Chief Operating Officer in March of 2012. He then took the reins as CEO in June 2014 before being appointed Managing Director in July of 2015.
Thank you, Katie, and thank you to Diggers for once again inviting Ramelius back to tell the story, noting that this is the 15th year that Ramelius has appeared on the program consecutively. It's my 10th. I would like to think that that's more to do with, as one of my directors once put it, there's always something happening at Ramelius, rather than the fact that I happen to be from Kalgoorlie. Perhaps a bit of both. Ramelius has an even longer production history, dating back to 2006, where we've grown production to current levels of around 250,000 ounces a year. But we've got ambitions to push this sustainably beyond 300,000 ounces. This year's presentation has a little more M&A substance, for obvious reasons, as opposed to updates across the full portfolio. Although I will touch on some of the great work we're doing on progressive rehab, no better illustrated on the opening slide here at the Tampia mine in the WA wheat belt. Noting our forward-looking statements and contributions by our competent persons, if I may start with a corporate overview. Current market cap, approximately 1.3 billion. A little over 270 million in cash and gold and no debt, although we do have access to a currently undrawn $100 million facility, should we feel we need it, although it's likely to be related to more M&A activity, as our operations are indeed cash flow positive. We did finish FY23 just above 240,000 ounces, with a pretty respectable all-in sustaining costs of 18.95 Aussie an ounce. Importantly, we're able to add almost 43 million to the coffers in the June quarter, surely a sign of positive things to come at Ramelius, with the high-grade Penny mine hitting its straps, further supporting our claims that our all-in sustaining costs, while currently pretty competitive, will reduce even further through FY24 and 25. To this point, our guidance for FY24 is for 250 to 275,000 ounces, at an all-in sustaining cost between $1,550 and $1,750 an ounce. This chart uses actual all-in sustaining cost up to FY23, and then the midpoints of our guidance for FY24, and also the 3-year outlook, which we published in November last year for FY25. The yellow line is realised gold price, and we achieve an increase in gold price going forward simply by using spot, combined with our spot at 28.80, combined with our hedge book. As you can see, the potential to return to 40% margins overall in sustaining costs is pretty compelling. So therefore, Ramelius is in a unique situation with an increasing proportion of high-grade, low-cost production that will lead to a lower all-in sustaining costs over the next 2 years. Lastly, on the right-hand side, we are forecasting pretty modest CapEx, non-sustaining CapEx, for FY24, just 55 million at the midpoint. Lower than we've seen in previous years, adding further impetus to the strong cash flows we expect going forward. And this is in part acknowledges the all-in cost debate raised by Duncan Gibbs at Gold Road yesterday, whereby both all-in sustaining costs and non-sustaining capital should be considered. Indeed, everything else being equal, we are aiming for a cash balance in excess of 400 million by June 30 next year. Who said gold miners don't make money? Now let's look at our recent M&A activity, but first, starting with strategy, our mission at Ramelius, if I get to the right slide, is focused on being sustainable and delivering superior returns. And that's through a combination of capital growth and dividend yield, noting that we have paid a dividend the last 4 years running. We believe our values on the bottom left suit us down to the ground, and the essentials pinwheel on the right is simply about good governance. and not, as some have suggested, used by the BD team to spin up whichever ASX-listed junior is next. We deliver our strategy through our 5 strategic priorities, with our 2 recent acquisition targets hitting both Priority 1, which is feed existing hubs with the Musgrave offer, and Priority 3, ramping up greenfields with both the Apollo and Breaker acquisitions of the Rebecca and Roe projects respectively. I would also just like to mention that we've invested a lot in Priority 4, which is effectively our people, and we have a number of them coming and going over the 3 days of diggers. If I could first go to the Breaker takeover that we announced in late March, the Roe Gold project, some 50 kilometres from our own Rebecca project east of Kalgoorlie. Roe contains 1.7 million ounces. When combined with Rebecca's 1.2 million ounces, we have almost 3 million ounces of resources in a great location. The takeover completed in May, some 48 days from announcement to completion, which was the quickest process of all our acquisitions. As can be clearly seen on the map, the Rebecca region has the potential to become a new producing hub for the company, in addition to Mount Magnet and Edna May. A little more about the Roe project. If we zoom in further, it sits at the southern end of the Keith-Kilkenny tectonic zone, which also hosts Northern Star's Carosue Dam operation to the north. The jewel in the crown at Roe is the 1.5 million ounce Bombora deposit, which has both open pit and underground potential. As mentioned, it's only 50 kilometres from Rebecca, and ultimately the ability to combine exploration and development teams is already in progress. Both projects have the same pastoralists, the same native title groups, and are in the same shire, simplifying the combination of what I believe are the 2 best resources in this part of the world. Now on to our latest corporate venture, Musgrave Minerals, owner of the Q Gold project, only 40 kilometres as the crow flies from our Mount Magnet processing facility. Our offer, when it was struck, is at an implied price of 34 cents, made up of 30 cents of RMS paper and 4 cents of cash. The offer has been open for nearly 4 weeks, and as of this morning, we hold acceptances of just over 30%. The Q project contains almost 1 million ounces of resource at 2.3 grams per tonne gold, but has a high-grade, high-core margin that is open-pittable and that we believe will provide a healthy return, assuming that we bring it into the Mount Magnet profile within the next 18 months. Now, you may have seen Musgrave's presentation. Rob Waugh did an excellent job using the Verify software to give you detail on the Musgrave project. I'll just simply look to add the RMS perspective, if you like. So if we zoom into the Q project, similar to what I did with Roe, you can see that the tenement packages almost adjoin our own, both in the north with respect to the main Break of Day tenements, but also Mount Magnet South, where we're in porphyry-style rocks looking for similar deposits to our own Eridanus and Bartus deposits. I have mentioned on the last slide the high-grade core that is a feature of Break of Day, and here we're talking about 1 million tonnes at 10 grams for over 300,000 ounces, and this will be central to the economic returns and was the foundation of Musgrave's PFS released in May. This project is bread and butter Ramelius, small high-grade open pit and then underground with modest capex and exceptionally fast payback periods. Plenty of exploration upside at Q, as always, given it's located within the greenstones and on a splay off the Cutting-Warra Shear, which runs from Mount Magnet to Meekatharra, distance of some 200 kilometres. You can see the names of the pipeline projects. I won't read them out. I'll only say that I'm pretty encouraged by early stage hits like 11 metres at 8 and 7 metres at 23. Early days here, but obviously potentially new resources that extend life and increase value that Ramelius can extract for shareholders. A couple of brief updates on our current projects, and I have to always start with Penny. When I talk about high grade, I mean between 10 and 20 grams, which is the magenta colouring of Penny North on the right. We're up and running at Penny. well and truly. We have a number of ore drives in, stoping's well underway on multiple fronts, and the decline's well ahead of stoping. Of critical importance was the fact that we're able to live up to our promise, as shown by the chart bottom left, of removing the backlog stockpile that was sitting at the mine and get it into the mill by June 30. And that obviously led to a very strong Q4, both from a production and cash flow point of view. The underground drilling is progressing at pace. We've released some results, but as you can see, there are a number of results that are due to be received shortly, and we'll be releasing them along with a mineral resource update in the next month or so. At Mount Magnet, we're rehabbing the old Hill 50 decline. We're well past the takeoff points for the Mars ore body. We've commenced ore driving at Mars itself, and we've got some really nice hits, so it promises, especially in the upper levels of the ore body, to intersect some really nice areas. We've got a 5-year mine plan at Galaxy based on what you see, but given the typical BIF vertical continuity you see at Mount Magnet, and also the holes below the current mine plan, we're very confident of a much longer life at Galaxy than that 5 years. And with respect to Hill 50 itself, we have decided to prioritise other projects at Mount Magnet over Hill 50, such as Eridanus and Bartus. This will allow the full establishment of the Galaxy mine to build a strong production base for potential access to Hill 50 at a later point. Over to Symes, south of Edna May. It's a new project for Ramelius. We're gearing up for production commencement second quarter, actually somewhat earlier than what was contemplated in the 3-year outlook. Given that the Edna May mill is currently running at around 90% capacity, we figured an earlier start at Symes to get that capacity closer to 100%. Made a lot of sense. And given that it's, as you can see, it's soft oxide, shallow, high margin material, we think this will make for strong cash flows for the year or so that the Symes project is running. And as you can see, once again, similar to Tampia, we're mining right in the middle of a broadacre paddock in the WA wheat belt. And we are appreciative of the willingness of the local farmer to work with us at Symes. And unfortunately this year we had to close 2 of our operations. The Vivian mine at the top and the Tampia mine was completed in May. Unlike the vegetation, the gold doesn't grow back, as they say. But we've committed to carrying out progressive rehabilitation as much as possible in our projects, and there is an ESG metric on this, and we compare quite favourably to our peers on this one. And it also makes sense because leaving it to the end is generally much more expensive. You can see that obviously with Vivian in the northeastern goldfields, it's a much more arid environment than at Tampia, which we're in the middle of the wheat belt, but we're proud of the rehab we're doing on our mines, and we're mindful of what we're leaving behind. What are our sources of future growth? On the organic front, we continue to prioritise and work through our projects and the associated studies, understanding you cannot do them all at the same time, even though I generally ask the guys to do that. At Mount Magnet, as I said, we'll park Hill 50 for this year and focus on drilling below the Eridanus open pit, and also progress Bartus with an updated mineral resource, and then go into a scoping study at Bartus. As I touched on earlier, there's a mineral resource update at Penny, both the west and north lodes, and as flagged publicly previously, we are combining the Rebecca and Roe project and look to come out with an update on that in terms of a PFS in early 2024. In terms of inorganic growth, we continue to track progress and add projects to the story. By project on this chart, you'll see purchase price in blue, cash generated in yellow, and the net cash being the red dot and the number. We've got a nice trend here. Yes, we're for larger purchases, but we are generating larger and larger returns. Edna May, Marta and Tampia are still effectively in production, with the penny bar or the penny column now heading in the right direction with a $33 million improvement in the last quarter alone. So on penny, just think about 200,000 ounces of reserve at a $2,000 an ounce margin. That's $400 million. That'll get you above the line. In fact, that'll get you to redo the scale on the y-axis, I would imagine. 6 acquisitions in 6 years, and that doesn't include Symes. We've added to the chart. and obviously doesn't include Musgrave's Q project just yet. And our balance sheet remains strong such that we can, as opportunities arise, we can move quickly, and being nimble is obviously a key part of what Ramelius does. So to summarise why we believe we're well placed going forward, we believe we're good operators and we've got an experienced and stable team. We have a strong balance sheet and a disciplined approach to capital management, including being a regular dividend payer, and remain ready to act on any acquisition that's accretive. So it's fair to say we're match fit in this area, really match fit. We continue to support both greenfields and brownfields exploration. We're putting significant dollars into that, 30 million this year, because we believe that our projects such as Mount Magnet, Penny and Rebecca Roe will continue to deliver resource increases. Lastly, keep an eye out for exploration and resource updates, and we'll obviously keep the market informed on our progress on the Musgrave offer. Thank you for listening to the Ramelius story. We're at booth 48. I'm not sure why we quote the number because no one knows where that is, but it's first corner to the right. There's a couple of drillers there, Top Drill and Sandvik are there, so it's Driller's Corner, but I'm a bit concerned that Mining News are there and they might call that the naughty corner. But we, if you follow some of the FY24 gold guidance, you'll understand what I mean by that, and we're probably in the wrong spot. But anyway, come and see us. The team's there. I look forward to it. Thank you.